Deep under Manhattan, behind blast doors and bedrock, sits a room full of metal that could rewrite the story of the US dollar in a single announcement. I'm talking about America's gold, officially 8,133 metric tons, recorded on the government's books at a price that belongs in a history textbook, $42 an ounce. Not the approximately $2,900 markets trade at today. 42. On paper, that tiny number hides roughly $750 billion in unrealized value. It's like having a skyscraper on your balance sheet booked as an empty parking lot. Now here's where it gets explosive. The new Treasury team has openly said they're going to monetize the asset side of the U.S. balance sheet and stand up a sovereign wealth fund within 12 months. Translated, they're getting ready to reprice that gold. This episode isn't about gold bugs or tinfoil hats. It's about how one policy move could reset debt, shake the dollar, and completely reorder who wins and who gets wiped out in the next decade. Officially, the U.S. Treasury claims more gold than any other nation on Earth. Fort Knox, West Point, the Denver Mint, and the New York Fed's underground vault together account for about 261.5 million troy ounces. On the balance sheet, all of that is valued at the statutory price set decades ago, $42.22 per ounce. If you plug that into a calculator, the government is telling you its gold stash is worth roughly $11 billion. Use current market prices instead, and that same metal is worth around $760 billion. The difference, about $749 billion, doesn't show up anywhere. It's invisible capital, sitting in the dark. Most people never think about this because the number looks boring in official documents. Gold certificate account, statutory price. Dry language hides a very simple fact. The U.S. is sitting on a gigantic asset that accounting rules pretend doesn't exist. That gap between what the books say and what the market says is exactly where the current Treasury team wants to operate. They don't need to mine new gold, raise new taxes, or cut new programs. All they have to do is change one number, the official price, and hundreds of billions appear on the government's balance sheet overnight. We've seen this movie before. During the Great Depression, Franklin D. Roosevelt faced collapsing prices, broken banks, and a deflationary spiral that threatened the entire economy. He didn't have digital money printers or trillion-dollar deficits to work with. What he had was gold and the power to change its official price. Step 1. He banned most private gold ownership. Through Executive Order 6102, citizens were told to hand in their coins and bars at the official rate of $20.67 per ounce in exchange for paper dollars. Once the metal was in government hands, Roosevelt moved to step 2. He raised the official gold price to $35. With a stroke of a pen, the value of the government's gold hoard jumped by about 69%. The Treasury's gold pile went from roughly $4 billion in value to about $6.8 billion, without digging a single new ounce out of the ground. The debts the government owed were still denominated in dollars that had just been quietly devalued against gold. In real terms, the burden of that debt shrank, while the asset side of the balance sheet ballooned. It wasn't magic. It was revaluation, using gold's price to shift the entire financial equation in the government's favor. Fast forward to now, the United States is staring at a problem much bigger than Roosevelt's dollar gold tweak. The national debt has blasted past $36 trillion, and it's growing at roughly $1 trillion every 100 days. The interest alone, just the thank you for borrowing line item, is running over $1.2 trillion a year. That's more than the defense budget, more than Medicare, second only to Social Security. A huge slice of every tax dollar is going straight to debt service, not roads, schools, or hospitals. Raising taxes enough to fix that? Political suicide. Slashing spending deeply enough? Just as toxic. Defaulting? That would blow up the entire global financial system. So policymakers are boxed into a corner with one asset nobody talks about, that underpriced gold stack. Revaluing it to market levels would instantly create hundreds of billions in new balance sheet strength, without passing new taxes or begging Congress for more borrowing authority. It doesn't solve the entire problem, not even close, but it buys time, changes perception, and gives the Treasury something it desperately needs: collateral for whatever comes next. If this were just a theory, you could ignore it, but the breadcrumbs are already there. First, the Federal Reserve's own accounting manual was quietly tweaked. A little noticed update to the section on the gold certificate account clarified that the Treasury Secretary can issue new gold certificates to the Fed and monetize the government's gold. Translation: the plumbing has been updated so revaluation can actually flow through the system. Then came the gold tariff shock. One morning, the administration announced a 39% tariff on imported 100-ounce gold bars, the exact bars used to settle futures contracts and underpin much of the global gold market. It hit refiners in Switzerland, the heart of the world's gold processing system. Prices spiked into chaos. Within hours, the White House reversed course. Gold will not be tariffed. Markets calmed down. Most people shrugged it off as a policy blunder, but to anyone watching closely, it looked like a stress test. How fast does the gold market react to U.S. policy? How fragile are supply chains? How quickly do global traders panic? You don't run that kind of experiment by accident. You run it when you're gathering data for a bigger move. Now add one more piece: the proposed U.S. sovereign wealth fund. Sovereign wealth funds are giant national investment portfolios. Norway's is about $1.7 trillion. China's over $1.3 trillion. They use oil money, trade surpluses, and other state assets to buy stocks, infrastructure, and strategic stakes around the world. The new U.S. plan aims for similar scale: a fund big enough to repair decaying infrastructure, buy critical tech assets, and project American economic influence abroad. There's just one problem. Where does the seed money come from? You can't realistically raise taxes enough to fund a trillion-dollar vehicle while interest costs are already eating the budget. You can't credibly borrow another trillion just to start an investment fund when you're already borrowing to pay interest on existing debt. That leaves one clean, politically sellable option: monetize the gold. Revalue the official gold price from $42 to something closer to market levels, and suddenly that hidden $749 billion becomes a usable asset. Those revaluation gains can be pledged, securitized, or used as direct capital for the new fund. To a businessman president and a Wall Street savvy Treasury Secretary, that's the ultimate move. Unlock a dormant asset, leverage it, and use it to build a new financial machine. Repricing gold to market levels is one thing. Using gold to underpin a new version of the dollar is something else entirely. Some analysts argue that if you wanted the dollar to be meaningfully backed by U.S. gold reserves at historic ratios, the gold price wouldn't stop at $3,000 or $4,000. It would need to move into five-figure territory: $20,000, $30,000, even more per ounce, depending on how much debt you're trying to dilute. At those levels, the government's 8,133 tons become a multi-trillion-dollar asset. That kind of revaluation could slice the debt-to-GDP ratio down dramatically without a single bond being paid back in full-strength dollars. You're not defaulting in name. You're just paying back in a currency that's worth less relative to real assets. The catch? Inflation. When you aggressively mark up your anchor asset, you're signaling to the world that your currency is worth less than previously assumed. That tends to ripple through food, energy, housing, everything within 18 to 36 months. For Washington, that's a solution. For savers sitting in cash and bonds, it's a slow-motion wealth transfer. The same playbook Roosevelt used in the 1930s, just scaled to a 21st century debt mountain. All of this rests on one uncomfortable question: how much gold is actually in those vaults? The U.S. talks about its gold hoard constantly, in reports, in speeches, in official tables. But full independent verification hasn't happened in over 70 years. The last meaningful inspection was in the early 1950s. A small media tour in the 1970s checked a sliver of the holdings. Then the doors shut again. Meanwhile, other major holders quietly audit their reserves. Switzerland, Germany, the Netherlands. They weigh, test, and photograph bars. The U.S., supposedly the largest holder of all, shrugs and says, "Trust us." Before any serious revaluation, someone has to answer the basic questions. Exactly how many ounces are there? What's the purity? Are there any long-term leases, swaps, or encumbrances attached to that metal? If an audit reveals a shortfall, the story changes, but doesn't end. In that case, Washington has a built-in excuse to go shopping, to acquire more gold at current prices under national security authorities, then revalue the entire pile at a much higher official price. Whether the vaults are full or partially light, the incentive to run the revaluation play only grows. America isn't making gold moves in a vacuum. Over the last few years, central banks in China, Russia, India, Turkey, Poland, and others have been loading up on gold while shrinking their exposure to U.S. treasuries. They've watched the same debt charts. They've seen reserves weaponized through sanctions. They understand that a dollar system dependent on ever-rising debt and ever-lower interest rates cannot run forever. If the U.S. formally revalues its gold, those countries with big piles of their own suddenly get a windfall. Their reserves would explode in local currency value overnight. Nations without meaningful gold would be left scrambling to catch up at much higher prices. Then there's oil. For decades, the petrodollar arrangement, oil priced and settled in dollars, has underpinned demand for U.S. currency. But if the dollar becomes a gold-aware or partially gold-linked unit again, oil exporters will have new leverage. They could demand payment structures that reference gold, accept gold-backed guarantees, or shift more trade into currencies backed by hard assets. The result isn't the end of the dollar, but a different dollar, one that shares the stage with other gold-anchored claims. In that world, who holds real metal, not just paper, matters more than ever. Gold revaluation wouldn't just happen on a random Tuesday. It would be a choreographed operation. First comes optics and groundwork. A Fort Knox-style audit to reassure the public there's real metal behind the headlines, followed by legal and accounting tweaks, most of which we're already seeing, to ensure the Treasury can issue new gold certificates at a higher price. Next, quiet coordination with big players, major banks, primary dealers, key foreign central banks. They don't get the exact date or number, but they're prepared so the system doesn't break under the shock. Then, at some low liquidity window, a summer weekend for example, the announcement lands. The Treasury sets a new official gold price far above $42, updates the certificates held by the Fed, and instantly inflates the government's balance sheet asset column. Markets would react violently at first. Gold gaps higher. The dollar swings as traders reassess its value. Bonds sell off as inflation expectations jump. Stocks reshuffle, with hard asset plays and exporters likely favored over pure financial engineering. From there, the story becomes one of inflation versus debt relief, a tug-of-war between savers losing purchasing power and the state quietly shrinking its obligations in real terms. It's easy to hear all this and think, well, that's a Washington problem. It isn't. It's a household problem. If the U.S. leans into gold revaluation and stealth devaluation, anyone sitting on a pile of cash, low-yield bonds, or fixed pension promises is effectively volunteering to subsidize the reset. Your purchasing power becomes the shock absorber that protects a debt-bloated system. On the other side of the line sit people who own real things or claims on real things. Physical precious metals, productive businesses, prime real estate, assets in currencies or markets less tied to a single government's debt problem. They don't escape all the chaos. Nobody does. But they're not standing still while the floor moves. The point isn't to panic or dump every dollar you own. It's to stop pretending that the current system can roll on forever without major rule changes. When you see the Treasury updating manuals, testing gold markets with tariffs, and openly talking about monetizing assets, you're being handed a rare gift: early notice. In any reset, someone pays and someone positions. The math doesn't care which side you choose, but your future self will. If you've watched this far, you're already ahead of most people who never look past headlines like record gold price or rising national debt. You now understand the deeper story: a government sitting on massively underpriced gold, a treasury openly hinting at monetizing hidden assets, and a global financial system quietly preparing for new rules. The next few years aren't just about whether gold hits $3,000 or $4,000. They're about whether the entire architecture of money shifts around you while you're still playing by 1990s rules. You don't need to become a gold maximalist. You don't need to bet the farm on one outcome. But you do need a plan that assumes the people running the system will choose the path that saves themselves first. And that path almost always involves devaluing the money, not the debt. On this channel, we're going to keep unpacking moves like this. From central bank gold buying to sovereign wealth funds to debt math no one on TV wants to talk about. And, more importantly, what they mean for your savings, your income, and your options. If you don't want to sleepwalk into the next reset, hit subscribe, turn on notifications, and stay with this series. The rules of the game are changing. I want you watching the scoreboard, not guessing from the sidelines.